Good afternoon. It's good to be back in Iowa, I think. It's certainly good. I'm reminded of a story many years ago. Lou Holtz became the head football coach at the University of Minnesota, and they introduced him, sometime in December, and had him up there with a Minnesota cap on. This was before he went to Notre Dame, and they asked him where he planned to do most of his recruiting, and Lou said indoors. And I think that's a pretty appropriate thing for today. We did move back to Oklahoma, back to Oklahoma for me, to Oklahoma for my wife in September to get nearer my parents, and that has gone well, but I'll still spend quite a bit of time in Iowa, especially working with the pork producers, the National Pork Board, National Pork Producers Council. Let's get started here. First question, how many hogs did you negotiate the price for this week? Okay? Producers, how many? Okay? A lot of zeros out there, and that's one of the problems we have. You need to remember that when you don't negotiate hogs, you think you're having this guy negotiate for you when you probably have these guys negotiating for you. Okay? You take a risk that the people doing the negotiating that determines the price of the animals that you sell on your formula contracts are idiots. All right? Now, some of them aren't. Most of them aren't, actually. You're in pretty good hands there. But that is a risk that you take, and it's one that I think many of you probably need to rethink. This percentage that is sold on the negotiated market was down to 2.4% last year. It can't go down very much more. The rate of decline has slowed just because it's getting very close to zero. But it's certainly a problem here. These are the hogs that are determined most of the values on the swine and pork market formula price that we see quoted every day, and the two of those together determine the CME lean hog index, which closes the CME futures contracts at the expiration of each month's contract. In addition, the price difference between negotiated and the other price continues to grow. Now, part of that is obviously because of the slaughter capacity situation we were in this fall, but it started long before that the negotiated price started falling well below these others more often than it had in the past. And one point we'll make, too, is back here in 2014, negotiated and swine pork market formula were virtually the same. Look what's happened to them since then. There are more and more hogs being priced off of the cutout value, which is driving another wedge in this price system we have. Solutions to this, by far the best solution is for producers to simply solve the problem by negotiating more hogs. Now, you come off of the fall of 16, you say, well, gee, I would have negotiated, but it's too risky. I understand that. That's not going to be the case for the next couple of years. You're going to have opportunities to negotiate hogs, and you can put some thickness back in this market. Second one's moved to the cutout value, and a lot of hogs have moved to the cutout value, and that's not a bad solution. It basically abdicates your responsibility, but it still is a pretty good solution. The market solution, this is a tragedy of the commons, where because nobody owns this, producers are not getting paid to produce the information. The users of the information don't have to pay to use it. If you use it, it doesn't diminish its value to me. It's one of those, what we economists call tragedy of the commons, and you can solve that by charging users and paying the people that are generating the data. But that's a complex thing, and in our market it would take legislation and a referendum, and that's probably a lot of trouble to go to. But the next one is even worse, in my opinion, and that's mandating that you have to sell and packers have to buy a set percentage of hogs to try to determine value in this hog market. I don't think that's a good idea, but there's some people that are defaulting to that, and I think it's going to have a lot of problems should we try to do it. I don't know that the Congress is in the mood to do that, but the Farm Bill of 2018 is very likely to have something about this market situation in hogs, and you can solve that between now and then by simply negotiating more. I didn't say negotiate all of them. Negotiate 10%. Negotiate 15%. That would really help us and put some thickness in this market. Okay, that's my soapbox. I've committed to be on that soapbox for this year because I think it's really important, and I think producers need to answer the question, how many did you negotiate? All right? And I hope that you'll do that and give it some thought. All right, beyond that, what do we got? Well, the big issues for this year clearly are domestic supply. I think is probably the number one that we have. We have some situations that are going to help us with that as we go through the year. but still, I think the number of pigs out there, and especially coming off the December hogs and pigs report, is item number one. Domestic demand has been remarkably strong, and I think is something we can be proud of. The demand at the retail level has remained relatively strong. It's weaker than in 2015, but I don't think that's a problem because 2015 was kind of off the charts. But as we look at what's happened at the wholesale and especially the hog level since about the 1st of November, I think we have to conclude that the demand for hogs has been very, very strong relative to the supply. The world situation, pork supply, economic activity, trade environment, obviously going to be important. Exchange rates and trade relationships. The exchange rate, I think, has been the dominant factor in exports for the last a year and a half. I don't know if it'll be the dominant factor going forward, but it's certainly an important one that we need to always keep in mind. Regulations, the GIPSA rule, WOTUS, or the organic rule that now includes some things on animal welfare issues. Those have been delayed, as I understand. The net effect is to delay them for 30 days, the proposed rules that were there. There will probably be some legislative fixes to some of these, especially the GIPSA rule. And then finally, the 2018 Farm Bill. We're going to start work on that. Senator Stabenow announced this last week that she's starting to hold some meetings, getting ready for the 2018 Farm Bill. And I always go into a Farm Bill wondering if it's going to be any help or if it's just going to be a big thing of mischief. And normally I've fallen on the mischief side on that. The silver lining we've had this last year, and I think going forward, is lower costs. We've caught up with the situation with ethanol, with corn supplies, and reduced these prices. Our model, based on the Iowa State University parameters for farrow to finish operations, have $66 or so on these break-evens, and I think these represent probably the best producers out there. I believe they're lower than what the average is by $4 or $5, but you can see slightly higher than last year. Last year was the lowest since 2010, and they continue to creep up. Now, they're creeping up because of things really probably not very related to the corn market. We got world corn consumption and production at record highs. We have world corn carryout stocks. This is the FAS data. It's record high. If you looked at the WASDE data last week, it's slightly off of last year's number, just barely. So for all intents and purposes, staying the same. The balance sheet out of the WASDE, which was the final estimates of the 2016 crop, we've seen the numbers: 174.6 record yield, 15.148 billion bushels crop, record crop, 2.355 billion bushels of carryout, 16.1% stocks-to-use ratio. I mean, these are all very large numbers, and yet USDA put a nickel on both ends of their price forecast, and we've seen the futures markets trading up in recent weeks. I think corn is trying to keep up with soybeans, which is being driven by the situation in South America, is the driving factor. But the point is, with 2.355 billion bushels of carryout, we could take one bad crop and really probably not have a huge impact. $4.50, maybe $5 corn. It would take two bad crops in a row, in my opinion, for us to be challenging that $6 or $7 corn price that we saw back in 2012 and 13. Ethanol usage has flattened. I think hope springs eternal among the corn lobby that they're going to get, that the Trump administration will tell the EPA to use 15 billion gallons of ethanol. I think that's folly. I don't think that's going to happen. Number one is it would be very difficult for the companies to actually use 15 billion gallons of ethanol in motor fuels because we don't use that much motor fuel and we don't have that many E85 cars on the market. So I think this is going to stay pretty much flat. We still have increasing yields. It's going to cost us a few acres this year. I don't think there's much question about that. But the total, if you add up total feed usage plus the DDGs available to the U.S. Livestock and poultry industries, the second highest number ever for this coming year. We think that that's recovered well, and so our feed availability situation is much better. Wheat stocks, world wheat production and consumption, record high wheat ending inventories. Not a real important thing to us here in Iowa, but in parts of the United States and in many parts of the world, wheat is a major feed grain. And so the fact that you got that much wheat setting out there is probably going to put a lid on any kind of rally we can see on the corn side. And the other thing to remember about wheat is, unlike corn, which is very seasonal, there's somebody planting or harvesting wheat somewhere in the world just about every day. I mean, and so this is kind of a steady availability item where corn might not be. We still have corn futures near 350 over the next year or so. This market is traded higher than that. You know that, up in the 370 range. Again, we think that's in sympathy with the soybean market, and we think that that's going to resolve itself probably as we go through the harvest season in South America. It depends on how bad the damage has been in Argentina from these wet conditions, but this is our forecast, and you can see pretty steady as she goes as we go through the next year or so. On the acreage side, returns for Midwest crop returns decidedly negative for corn the last 3 years, and especially last year. And so producers aren't going to stand for that forever. 2 to 4 million acres probably going to switch out of corn and back to beans for the 2017 crop year. And that battle is kind of it's been taken up by both crops in the futures market just in the last few weeks. Soybeans, doesn't seem to be any end to how many soybeans the world will use. Record production, record consumption, and very close to record stocks. But notice that we haven't increased those stocks the last 2 years, the projected year-end stocks. And so we're using everything we're producing, and that includes a record crop here in the United States. The biggest soybean crop we've ever raised, the largest yield we've ever had. And I think I want to direct your attention, especially to the bottom numbers on this chart. 420 million bushels carry out. That's 113% of last year, up 113%, pardon me, more than double. The stocks use ratio at 10.2%, more than double that of last year. And yet all of the prices, price forecasts by USDA, the midpoints of those ranges are up substantially. And by the way, the futures are higher than all of these price forecasts at the present time. So, well, it'd be higher than the midpoint. You know, this is demand, strong demand defined, larger supplies by any measure, higher prices, and so certainly a very strong demand. Part of that, from the future standpoint, again, is some anticipation that maybe these supplies in South America are not going to be quite as large going forward. That was not the right button. Our soybean meal forecast around 350. You know that it's trading about 370. It's run up in the last couple of months pretty dramatically. We thought that there was certainly a buy in December for basically soybean meal as far as you can see. I wouldn't characterize it as that now. It is all dependent on what goes on in South America, and then also how many more acres we pick up in the United States as we go through planting. So these are our forecasts as they are. We still think they're sound. The futures market's a little moved away from them a bit. The same is true from the supply standpoint for all the meat and poultry species. The bars here are total pork, beef, chicken, and turkey production worldwide, read off the right-hand scale. They're going to be record large at about 268 billion pounds this year in carcass or ready-to-cook weight. The individual species read off the left-hand chart, record pork production, record beef production, record chicken production. And if you look at the turkey line, there's not a lot of variability there, but it's very close to record high as well. And so a lot of product out there, and all of them are growing. I mean, we think 17 is going to be larger than last year for sure. U.S. production up about 2%, pushing 100 million pounds in 2017. The big increase in per capita consumption or availability was last year, 2015. Those are still going up this year, and we're up to about 217 pounds and change, short of the 2006 record of 220 pounds, but moving back to that. Now the question is, if you go back to 220 pounds, what's the price that's going to be required to clear the market of that much product? And it's going to be hard to maintain prices that we've seen at the retail level and get that done. On an individual species basis, I put this up just mainly for perspective on hogs. The blue line is pork, and you can see for many, many, many years we were roughly 50 or 51 pounds per person. Availability in the United States. The only two times in this chart that you deviate from that was in 96 and 97, which was coming off some high prices in 95, high corn prices in 95, 96, and then this period when we ran corn prices up here in the 2000s due to ethanol usage. And in those times, we pulled back the amount of product we were putting on the market in order to push prices higher. We've gotten past that, and this year our forecast is 51.7 pounds. That's the highest number on that chart since back in 1999. And so we're certainly going to have enough product out there, a lot of product for U.S. consumers. The economy is still reasonably strong, I think. I'm not sure it's as strong as the stock market indexes want to tell you it is with the advent of the Trump administration, but the Dow Jones average did break 20,000 yesterday or today. I guess it was this morning, I think. 20,000 on the Dow. The S&P is a record high. If we look at the GDP growth, the third quarter GDP growth, quarter to quarter on an annualized basis, was revised upward to 3.5%. I don't like that comparison personally because quarter to quarter kind of glosses over some seasonal things. The bars here are quarter to quarter 1 year earlier, and that number is only 1.7%. And notice that we're going to average pretty well under 2% for the year. That's not a bad economy, in my opinion. It's not a robust one by any stretch of the imagination, and a lot of things are going to depend on what happens with the Congress and with the new president and his program going forward. Real personal disposable income per capita has grown up about 2%, a short 2%, 1.9 for this year. The concern here is the trend. I mean, we were at 2.63 last year. That number month to month to month has been going down as far as the year-over-year gains that we have. So a bit of concern there, and this is kind of per person, how much money do you have after you pay your taxes? And so this is not indicative of a robust economy either, but it's not indicative of one that's going south in a handbasket. Demand has been such that we've taken this product and we've kept prices, retail prices, at very high levels. They've certainly come off the records of 2014 and 15 for beef, for 14 for pork, 15 for beef. Prices did fall as we went through the autumn of 2016, and there are a lot of people said, well, hogs are down, why aren't retail prices coming down? Well, the reason retail prices didn't come down was the retailers could sell all they had at the price they were asking. And there's no reason for them to discount the price if they can't sell more product. And if you look at product movement during the fourth quarter, it was pretty remarkable. Now, it did go down. November retail prices were 8% on a real basis lower than they were 1 year earlier. December prices were down again. So we did have some price response, but that demand is way more elastic. That means it's less quantity sensitive than is the demand for hogs. And so those prices never move as fast as the prices for wholesale pork or for hogs. They are coming down, and I think they're going to continue to come down here. This is kind of, the shock absorber is at the retail level, and we'll see kind of what happens this year. But I expect them to probably have some more downward pressure, even with kind of where we're going on this hog market, which we'll talk about in a minute. The measure we use for demand is real per capita expenditures. It accounts for price changes, real deflated price changes, and consumption changes both. We put those together. We can add those together across species, and that's the chart you have here. You might note that there's no turkey involved here because we don't have a good retail price of turkey from USDA. This year's numbers are lower than they were a year ago. Year to date, down 3.4% for all three species. And that is not an indictment of the numbers for 2016. It's a statement about how strong these numbers were in 2015. There have been some really good basketball teams, but when you compare them to the Golden State Warriors' 73 wins last year, they kind of pale in comparison. And that's kind of where we've been on demand this year relative to 15. It's just not a good comparison because 15 was off the charts. We think that this has been remarkably strong. I told the pork board at the beginning of the year if they can stay within 3 or 4% of last year, it's a win so far. Pork demand, real per capita expenditures down 3% for the year. Now, we had a tough month in November, and the biggest reason we had a tough month in November was price response at retail. That's one. And number two is we had a great month of exports that meant that real domestic consumption was lower than what it would otherwise have needed to be. If we look at beef, they're down 3.7% for the year. Chicken, 3.4%. Again, all of them, and all of these are going to start looking better I think, as we go into 17, because we're going to start comparing 17 numbers to a much more normal kind of 2016 as we go through the year. November exports were remarkably big. Matter of fact, record large on a product weight basis. This one is a carcass equivalent from the Economic Research Service, and it was just short of the record set back in February of 2000 or March of 2014. But still, great big numbers on exports, up 18% from a year ago. The year-to-date total now up 3.5. I've been kind of sweating my plus 4% forecast on this all year because it kept lagging and lagging and lagging, and we finally pretty well caught up. The December data will be out the 8th day of February, and so we'll kind of see what the year as total did, but we certainly have been showing some signs of strength here. Now, the point to be made, though, is unless December is really off the charts, we're still in a pretty much level kind of trend on exports. And with production going up like we think it's going to this year, if you're just level on exports, it's going to be a tough row on selling all that extra product on the domestic market. Now, we have exports forecast up 4% for the year. I think USDA now is at 5 and change, maybe. I know that Brett Stewart, who has forgotten more about export markets than I know, has 1% on his forecast. And so he's certainly the bear. I don't think there's any guarantee, and that's kind of even looking beyond what kind of mischief might go on the trade relationships, and in case you've missed it, there might be a little bit of that. We look at individual markets. The big driver in November was Mexico. Mexico has been, the first half of the year was terrible. They've been catching up the last 3 or 4 months, even in spite of a very weak peso. Somebody said, well, why are the Mexicans buying so much stuff? And I said, well, I'm afraid they think that their peso is going to be even weaker, and they're buying while the buying's good. And that's about the only good explanation I can come up with. But they certainly bought a lot of product in November and were a major reason for that total increase. Japan was up as well from a year ago, 21%. Other markets grew pretty nicely. China is still, kind of growing along down here slowly, but nothing like the little surge that we had last spring that set the futures markets off so hard. They've fallen back into a much more normal kind of channel. I think the key on this is going to be how much product does the EU have to ship to China, and what kind of price can they get it to them as we go through this next year. When this kind of started with Chinese picking up, by the way, China became the largest importer of pork in the world this last year. They passed the Japanese. When this started, the EU had lots of product available because it was product that the Russians used to buy, and they found a home for it. I don't think they're going to be able to increase their production in that fashion and keep up with rising demand in China. So there is a little bit of help there, but Chinese production is growing as well, and we'll see kind of what the balance comes out this year. But we still have total exports up 4%, and this is going to be one of the keys, is what happens to the dollar. Now, the last couple of weeks have been kind of encouraging to me. When we got past the election, we saw the dollar strengthen, and I think that was the futures market kind of betting on what might happen with a Trump administration and a fiscal stimulus package, and what that might do to inflation rates, and what the Fed could do to interest rates, and how that might drive the dollar up. And so you can see there's a long chain of events there. Since then, the last couple of weeks, it's kind of come back down and is trading back in this long-term range. It's going to have to prove to me it's going to stay back in that range again before I'm very comfortable with it, because I still think that chain of events of a fiscal stimulus package and possibly a little bit higher inflation rates, not much, but a little, and it won't take very much for the Fed to start jacking rates up, and if interest rates go up, we'll see the dollar strengthen again. I'm not sure we're past that, and if we aren't, then we're going to see this dollar index probably trade up well above 100 for some time to come. We'll see kind of what the futures markets does, but I'm a little bit encouraged that we've dropped back down into that trading range. Yesterday's cold storage report showed stocks of the 4 large species up 0.6% from a year ago, up pretty sharply from November. But the good news is pork is not the problem there. It was stocks of beef going up that was the big driver of that. Pork stocks down 12.5% from a year ago, and the lowest December in the last 5 years. If we look at hams, a very normal kind of sell-off in hams after a very good sell-off in November. Rib stocks leveled out and still well under last year. And the big one, of course, and the one that's really pushed the cutout, has been what's happened to belly inventories. Belly inventories, don't have my read on there. Let's see. I don't think I can move that around in this smooth. Can't do it. Belly inventories down sharply. There's 30-some%, I believe. It was a big number. It'd be more than that, almost 60,000 down to less than 20,000. So a big reduction. We've got bellies that have traded up substantially since November, really supporting the cutout. I know there's some other analysts here. We ought to put our head together and see if we can come up with anything that makes sense on predicting belly prices. I think the reciprocal of the inventories is probably about the best we can do, because it seems to be extremely, extremely sensitive to these inventories. When they drop, bellies take off. When they go up, bellies fall off a cliff. And so it's been a very, very rough ride for bellies, but right now we're on the good side of that. The profit outlook for this year, this was run day before yesterday, used the same costs you saw a while ago, which have been creeping up over the last few weeks. It would not include the rally we've seen in hogs, especially today. The nearby is up $2 and more, and the summer's up somewhere in the $1.50 range. But still black ink for 2017, coming off about $5 for last year, and that $5 profit had some substantial losses, of course, in the fourth quarter. Now, I think the important thing to note about this is just that the fact that it's positive means we're not going to slow any kind of expansion that's going on out there. You say, well, boy, we came off a really bad fourth quarter. Okay, we came off a bad fourth quarter. There were a lot of folks who didn't lose very much money on hogs in the fourth quarter, by the way, because they hedged them, and they hedged them very successfully. But the important thing is the outlook here is not negative at all to slow the expansion we're seeing, especially with new plants coming on, and that's what showed up in the December Hogs and Pigs report. This report was extremely bearish, in my opinion. The difference between the actual year-over-year percentages and what analysts thought they were going to be, that right column over there, those numbers are very big. I mean, they meant that the analysts weren't anywhere near as large as where USDA's numbers were. Now, I want to point out that I'm still kind of encouraged by this report, because USDA has been underestimating most everything in their report for about 2.5 years, and this kind of suggests that maybe they've caught up some. I hope they have. There's still some challenges here, but still the numbers fit together and are pretty sobering, especially when you look at a September-November pig crop of 4.8% more than last year, and so that's March through June slaughter. And that's the last real number we have. They've got a SEP-NOV farrowings of 3.9%, which fits with that. And then their intentions fall back to 1.4% growth and 1% growth. And I think that's probably too low. And so it doesn't really fit as from a continuity standpoint. When we looked at the breeding herd, the total breeding herd at 6.09 million, up 1.5%, looks good to us. And then we look at the state data and we scratch our head and go, I don't know how that happened. Okay, 20,000 sows fewer in Oklahoma. They never have made up for the 50,000 sows that we magically lost last winter in Iowa. There's just a number of things there that don't make much sense. Based on history and the fact that, one good thing about the sow herd is if it's wrong, I don't know that it matters. Because if you'd been trying to predict the hog market using the breeding herd, you would have been broke many, many times over the last decade. So we watched the sow herd pretty closely. When we look at the December report and the revisions of past farrowings, I think they drove this farrowings per breeding animal number ratio probably higher than it should be. It's up at 1.996 for the year last year. We're going to use 1.98 on that as our projection for this year. It goes along a little better with recent numbers. Now, we don't think that this downtrend is going to continue very much longer. In fact, we think it's leveling out right now. It's the reason we're using 1.98. But that would put us right at just short of 12 million litters this year, about the same number as in 2016. The thing we have to come to grips with is this pattern of revisions that USDA's had to do on the pig crop. Since the March-May quarter of 2014, they've revised every pig crop up. They've revised all but one of them up more than 1%. Most of them, a couple of them up 3% plus. The average has been 2.4, and that was the number for the most recent revision of the March-May pig crop. And so unless they've dialed this in a whole lot better going forward, we would expect more revisions to the pig crops for June, August, and September, November, and that would put you somewhere where that green line is, and would say that the Sep-Nov pig crop will be somewhere around 33 million head based on their forecast and recent revision patterns. So that's the reason we think we're really going to have some challenges there. Now, the other thing about USDA's revision is they've set up a situation where they're continually, in my opinion, underestimating the litter size. This is USDA's actual published litter size and what it will be over the next year if the normal differences with the September-November litter size occur again, the same ones that have happened over the last 5 years. Now, the question that I bring up here, and I've seen some individual or some production data from production systems. We've checked this against the AgriStats data, aggregated AgriStats data. I don't ever see any individual data on that. But the question that begs on this is, how did PEDV come along and permanently change the genetic capability of the U.S. breeding herd to produce pigs per litter? I mean, if you look right before PEDV, there was a set of sows, there was a set of managers and employees and facilities and procedures and all of those things in place to produce that many pigs per sow. And a disease that comes along that mainly kills baby pigs, and it has some impacts on other hogs, we know that, but how did it permanently change the genetic capability? Why, when we solved PED, why did we not move back to this line? I mean, that's the question. And I think the reason is because USDA has not properly revised their data. Because if they had revised litter sizes instead of farrowings to account for their misses on the pig crop, this is what the litter size would look like. Be right back to that line. Now, I know we had some troubles later, and you can see right there, we had PEDV again. We had PEDV again there. The next 2 winters, we had some impacts. But this would be the kind of where we are on litter size, and it makes a lot more sense than where we are now with the USDA data, and this is what we're using to forecast our numbers. Now, we have to play with the farrowings a little bit because USDA has over-revised those farrowing numbers up, but it's not an easy task, and I've spent a lot of times bleary-eyed over a spreadsheet trying to figure out exactly how to account for what I think has been systematic errors. And the problem with this is USDA has been underestimating the pig crop so consistently that they've sent a false security out there of, we need more pigs. And I'm afraid one of these days we're going to get way more than what we need. We've already got that. We already got the slaughter capacity in the fall, and that was just a matter of time until we did it. Some of you have been here every year the last several years. How many years had I been warning about a slaughter capacity problem? Okay? It would have happened in 2013 had we not had the drought of 2012 that drove up costs. It would have happened in 2014 had we not had PEDV. It did happen in 2015, but it only happened for 2 weeks. And we took hogs all the way down to $50. And then this year we got it in spades. So I guess now if I'll just keep saying the same thing year after year, it'll eventually come true. So, I'm still hoping for Santa Claus. But anyway, the other factor on supplies we have to pay some attention to is Canadian pigs. Now, MCOOL was repealed a year ago, December. We had already been increasing the number of wean pigs coming from and feeder pigs coming from Canada for about 2 years before that. And in fact, this year that number didn't grow nearly as much as what we had expected it would. We've had this up about 12% for the year. It's going to end up a short 8%, about 330,000 head. Market hog imports have been significantly lower this year because last year we had a couple of one-off things of a labor strike and a plant closure in Ontario that caused a lot of pigs to come south. The thing you have to watch on market hog imports is what happens when cold water opens this summer and we start bringing more pigs from Ontario that are currently going to Quebec to be slaughtered. And so we think that the number of market hogs coming down will grow pretty substantially in the second half of 17 and into 18, but we'll be watching this pretty closely. You add them all together, they're not a big number as they were back in the the early 2000s, but these numbers could certainly trend higher over the next couple of years and could mean something. The packing capacity situation, of course, has been front and center on most of our discussions for some time now. The Pleasant Hope, Missouri plant, Moon Ridge Pork, is operating. They tell me they're slaughtering between 800 and 1,000 head per day. That plant has a capacity of 2,500. They're working through some technical things with their cooler systems and such on that. The Windham, Minnesota plant has been delayed. We understand it's been delayed once again into the spring, and some equipment challenges there, and so I don't know when it's going to be up. The last I'd heard officially was February. The rumors from some people that have been at the plant say March or April probably. I don't have anything official on that, but still 4,000 head per day, and hey, the battery stayed in it. That's good. Triumph Seaboard and Clemens, those plants are still on track for this summer. The Clemens people tell me they hope to slaughter some pigs in June. So we're going to have some growth here, no question. And the real question, by the fall of 2017, about 6% increase in slaughter capacity relative to the average of 2015. But the fall of 2018 would add in the Prestige plant. They're to break ground this spring and say that they're going to be up and running in October. They won't be anywhere near full by then, okay? But so be available in the fall of 18. And then the question after that is how quickly do any of these plants go to double shift? I think the most likely one to do that on a pretty aggressive basis is the Triumph Seaboard plant in Sioux City. I show them if they were to be up running double shift by the fall of 2018, that'd be a 10% increase in just 3 years. And that's good for the capacity side, but if you fill it up, that's a whole lot of pork. And it certainly could, and that's 10% on head. If we add a couple percent more for weights, that could certainly get large. Here's a picture of that. We ran over capacity, I think 7 weeks this fall. You can do that by running extra Saturdays. Our weekly capacity is computed from daily times 5.4 work days per week. And sometimes you can run more than that. Sometimes you can run 9-hour or 10-hour shifts for a short period of time. And we've seen kind of the cost of that here in the last few weeks. We've had some plants that missed some time because of some maintenance issues that were probably related to being pushed very hard for the fourth quarter of this year. And so, this is where we are. You can see the increases coming the next couple of years. And the real question is, where are we going to be on supplies to fill those? Packer margins were record high this fall. If you add up the difference between the cutout value and the hog cost and then dollars per head for drop value, they were record high. And notice that in general, packer margins have been higher since about 2007. A lot of variability. It's not it's not quite as predictable a thing as it once was, but still a lot of variability, but generally higher. And that's one of the reasons we're seeing expansion. There are people that have decided that capital can go there and make a return. When we look at slaughter, this is our forecast for weekly slaughter, and you can see our forecast for the first 3 weeks of this year were quite a bit higher than what the actuals have been. Now, I don't think we can keep that up very long, and I think it's probably a function of what it took to keep those weights constant all during the fourth quarter of last year and the flow of pigs that had to go through in order to do that. We're probably a little tighter on supplies here than maybe we had forecast and we had anticipated. We still think we're going to run up here above 2.3 million for much of the spring once we kind of get out on a steady pace on these plant operating. The red is last year. You can see the weeks above the slaughter capacity, and of course the fall of 2017 capacity will be up there. But we're going to be right at that when we get to the fall of 17. We think the plants are going to be virtually full by that time based on what we think is productivity and the number of sows that are out there. Weights were a real savior this year. They took about 1.5% off of production during the fourth quarter. There are two groups that I think really did the yeoman's work on this, and that's producers and the people that work in packing plants. I mean, they worked very hard. They got paid some extra, but they sure put in some long hours in order to get all these animals slaughtered at the pace that we had it and keep these weights from being a problem. Pork production, we've got production up about almost 4% this year. 3.9% this coming year. We were up a short 2% last year. The fourth quarter of 2017 we think could be 5% larger, a little over 5% larger than the fourth quarter of this year. And that's kind of a chilling thought if you think that this year was already 3% larger than in 2015. So a 2-year period, fourth quarter goes up by 8%. That's a big number. And it's certainly going to put some pressure on prices. Now, the good thing is we think that demand is strong enough that the cutout value is going to be stronger this summer, especially after the plants come on. We believe that we had a sell-off, a huge sell-off in bellies in August that pushed this cutout value sharply lower. That's kind of unusual, and we're going to, for now at least, track it up to unusual circumstances in the belly market. I'm beginning to think that the circumstances are always unusual in the belly market these days. But we still got cutout values staying in the 70s in the fourth quarter of 2017. Up in the 90s, the low 90s in the summer months. Slaughter, every quarter 4% or more except the third. And the only reason it isn't is there's one less slaughter day in the third quarter of this year. The total for the year up 3.2%, big growth from a year ago. Notice we have plenty of company in that. Lee Schultz's number is very close to ours for slaughter growth this year. The LMIC is a little less bullish than we are on this thing. Our number last year was very close to where we ended up actually up 2.4% from 2015. Our price forecasts, we came out with these right after the December Hogs and Pigs report. You can see relative to the futures over on the right that our forecast, every one of the forecasts on here, are substantially below where the futures are now. This is based on what we think demand and the supply of pigs means for the market. Obviously, the people trading futures right now would differ with that, and our first quarter number is clearly too low, given that we've traded national net hogs well over $60 the last week or so, and that number for the quarter, unless we just fall apart as we go through February and March, is probably going to be above $60, where we had it at 54 to 58. Now, what does this tell you? Well, it tells you, number one, that Meyer has to revise his first quarter numbers, and probably the rest of the year. But what it really tells me is that the fundamental analysis that I lean on is not nearly where the futures market is, and that spells to me a developing opportunity for you to price hogs. I don't know if it's there yet. I can't remember a year that I would say you ought to hedge summer hogs in January. All right? Probably has been one. Has there been one, Dow? Not that you don't have as much gray hair as I do, but I don't think there has been. So, given that, I would have my powder dry, keep my powder dry, and be ready to move when this market starts really looking toppy, and watching the technicals for those kind of signs. I think you're going to have a chance to sell all of your hogs in this year at over $70, probably $72. That very, very well could be the case. And if you pass on that, then shame on you. I just don't think that that would be a smart thing to do. Now, I said the same thing last year and actually ended up right for once. Those summer markets came kind of back to where our technical, our fundamental analysis indicated they were going to be. The fourth quarter did trade better than where we thought it was, and I'm still surprised by that. But I sure think there's going to be some opportunities here to lock in profits for this year. Risks to the forecast. Major export disruption, always number one. Small probability. Huge impact. That second disease there is President Trump disease. It's a very high probability at this point, but with an unknown impact. And so, how much impact is that going to have? Now, one point I will make about President Trump and export disruptions. I don't think you're going to see a lot of it in 2017. Most of it is going to be much longer term. Withdrawing from TPP really didn't have any impact. TPP was dead anyway, and it wouldn't have impacted your markets for 2 or 3 or 4 or 5 years. All right? Renegotiating the NAFTA, that's going to take some time. I don't think it's going to be a big impact. There will be some things that we might have that impacts our market, but I don't think most of them are going to come from the President Trump side, probably in 2017. Diseases, the focus now is this winter. PEDV has been good. We've heard of a number of sow breaks in Illinois, southeastern Iowa over the last week or so, 2 weeks. We don't have any data yet. We'll look at the data from the University of Minnesota here in the next couple of weeks to see how bad that's been, how widespread. But still, even if we have the same situation we had last year, I don't see that, or even a bit worse, I don't see it being a major impact on supplies going through the summer. PERS, the same thing. We've had a few breaks back in December that a little bit out of line, but not as large as a year ago when we had the new strain that was a little more devastating. So individually, many of you are going, well, wow, it's pretty bad. Yeah, I know, it is individually, but when we look at it market-wide, we haven't seen much data that says that this is going to be worse than last year. Feed costs, this year's okay. How about the next year? Well, a month or so ago, I would have said pull the trigger on feed, on pricing some feed ingredients for even the 17-18 crop, because I thought that it was a pretty good buy. Now, they've traded up based on this Argentina situation now, so I'm not sure that you should act here. But I would be kind of looking at the 17-18 year as we go into the planting season to see kind of where we are on that. The numbers that I think, $3.30 corn on the board, $330 meal on the board. If you get numbers down below that, I don't think you're going to leave much money on the table. Okay, I'm sure that's too simple, but it certainly looks like where we are in this market at least for the short term, unless we end up with a very, very short crop. Demand growth in 17, domestic. What's going to be the factors? Of course, preferences. That's been our driver for the last couple, 3 years. If we get some wage and income growth here, more than what we've seen, I think that could be really positive for meat demand. People eating out, we're still one of the more expensive things they put in their shopping basket. Exports, China, Hong Kong, Mexico, and the U.S. dollar are the issues. Now, the Mexican situation, I think the thing to watch there is how much growth in Mexico. We've been hearing a lot of talk about substantial growth, 200,000 new sows going into Mexico over the next 2 years. That's on a 1.5, 1.6 million breeding herd. That's big growth. There's a group from the pork board going to Mexico in early March, and I've tasked a couple of the people going on that to find out what's going on there, and the consequences are pretty significant in my mind. If you have that kind of growth in Mexico, they have a free trade agreement with Korea, and they have a free trade agreement with Japan. I think they would have very strong license to be selling loins and tenderloins, especially into the Japanese market, and keeping hams and shoulders, which we normally sell to the Mexicans, in their own market. And so they would be competition in both of those export markets for us. So I think there's some real risk here that we need to watch over the next couple of years. That expansion started last year. I don't think we're probably seeing hardly any pigs out of that expansion yet in Mexico. And they always had the problem of feed supply there, and I understand that. But a free trade agreement, when we don't have a free trade agreement with those folks, might make it. Now, we do have one with Korea. It's a long ways from being implemented and taking our tariffs down to zero. The impact of competition for hogs this fall, we had originally said $1 to $3 probably. Our friend Joe Kearns up at Ames said, no, it's going to be 5 to 7. And I don't know if he's compromising, but I guess I'd say 3 to 5. I think the competition will be positive for the hog market. It's going to we're still going to have pressure on cutout values because of the quantity on the market, but still they're going to chase a few hogs. Pork prices at the plants are full in the fall of 18. If we were to fill those plants up, especially the third one, the Prestige plant, that's going to be a lot more pork to move, as I pointed out, about a 10% increase from 15 in terms of capacity. And then if you put a normal kind of 1% growth or so on weights on there, that's well over 4% more pork per year for a 3-year period, and that is a very, very aggressive growth rate. We have time for some questions. Yeah, Robert. It's a mixture, Robert, from my understanding, of the Northwest, starts with an S, Saguaro? Yeah. And down in the Yucatan. It's growing in both places. But most of it is in the Northwest, which would suggest that that's certainly aimed at export markets. Well, I realize that not everyone probably is in a position to do that. Some people are, and some people aren't. If you're, and one of the things is a lot of people look at this and go, well, wait a minute, I get more money if I do a contract. And I understand that. And we all need to recognize that if we do what is best for us individually, then collectively there's going to be a cost to it. All right. Now, maybe that's not a big deal, but how are you going to price those pigs if nobody negotiates? And that's the point. I mean, if we keep saying let the other guy do it, what if the other guy doesn't do it? And then your formula doesn't work very well. Now, as I pointed out, I think the cutout value that USDA is publishing now is a reasonable alternative. It's based on mandatorily priced pork products. They have just updated the yields, and they're going to supposedly do that once a year, which should keep us kind of modern on that. I would hope so, because that doesn't get the shift. So I think that's a reasonable alternative, Ellen. But again, if you think you need that negotiated market, then letting somebody else do it all the time is probably not the best answer. And I understand, especially this fall. I know a lot of people that are, adamant believers in negotiating pigs that had pigs on formulas this fall because they wanted to make sure they had shackle space. I don't think that's going to be a big problem for a little while here. So that's something to keep in mind. Oh, yeah. We got some packers in the room. I think all of them have some agreements that use the cutout value for all or part of the price. There are some that are a combination of the hog market and the cutout value. The key on that, of course, is what's the relationship. If it's somewhere north of 90% of the cutout value, that's probably functional. All right, that's reasonable. If it's south of 90%, I'd say that's not a good deal for the producer from a historic basis. It would be best if we had a good measure of drop values so that we could adjust that. But, you just need to kind of consider what works for you and what you can negotiate with the packer. But I know of most of the packers I know of have done cutout value contracts. Yeah, just because it's a cutout value contract doesn't mean it's good.